TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
So if you've ever looked at your screen and, wondered why the stock market sometimes just completely ignores terrifying, earth-shattering global news.
Oh, or why it suddenly violently reverses direction in the middle of a random Tuesday, right? For seemingly no reason.
Exactly. Well, this deep dive is going to give you those aha moments you've been looking for. Our mission today is deciphering an absolutely wild week in the financial markets, specifically the week of April 20th through April 24th, 2026.
Yeah, it was a week where global geopolitical tension basically collided head-on with the hyper-fast world of 0 days to expiration or zero DTE options trading.
Right. And to figure out what actually happened under the hood, our sources today are a stack of highly detailed daily quantitative notes. We're looking at the AM and PM briefings from the financial analytics firm SpotGamma.
And SpotGamma is great because they track what we like to call the invisible plumbing of the stock market. So, options flows, dealer positioning, and those critical gamma levels.
Which secretly dictate market movement, yeah. We aren't looking at what talking heads felt about the market. We're looking at where the actual money was structurally positioned.
Exactly. It's the mechanics, not the emotions.
So let's just set the scene. It's Monday, April 20th. The market is sitting comfortably near all-time highs. The S&P 500 is around 7,126.
Yep.
But there is this massive tug-of-war happening between the macro headlines and the micro options flows. Because on the macro side, there's real tangible fear.
Oh, absolutely. Over the weekend, the Strait of Hormuz was closed due to severe tensions between Iran and Israel.
Right, and oil is just surging. WTI crude jumps 5.7% to around $87, and Brent is up to roughly $95 a barrel.
Which is huge. Normally, a shock to the global energy supply line of that magnitude would send equities tumbling immediately. I mean, you'd expect a massive sell-off.
People dumping risky assets, buying safe havens, sure.
Right. But when we dive into the SpotGamma data from that Monday morning, we see a totally different reality playing out in the plumbing. Despite all that geopolitical fear, there is a massive surge in call options.
And just to clarify for everyone listening, a call option is basically a leveraged bet that the market is going to go up.
Right, exactly. And traders were buying these calls at a staggering rate, vastly outpacing put options, which, are what you buy for downside protection.
And the specific data here is pretty wild. Call volume in single stocks was up 30% over the one-year average.
Yeah, and it wasn't even spread out. It was heavily concentrated in the Magnificent 7 mega-cap tech stocks. Call volume there was up an incredible 70%.
We even see a meme stock revival hiding in this Monday data, right?
Oh, yeah.
Looking at the notes, GameStop GME saw $1.9 million in premium spent on January 2027 $30 calls. And ARM saw $12 million spent on bullish 2027 calls.
Which is just a crazy amount of forward-looking optimism.
Okay, let's unpack this. Because to me, this market setup is like building a heavy top-tier luxury penthouse, which is, all this massive call option, buying in tech directly on top of a major geopolitical fault line in the Middle East.
That's a great way to look at it.
It just feels incredibly top-heavy and totally oblivious to the fact that the ground is literally shaking underneath it. Like, why are traders buying millions in tech calls when a global waterway just closed?
If we connect this to the bigger picture, your penthouse analogy is spot on. What the SpotGamma notes argue is that the recent volatility crush and the relentless rush to buy tech calls actually levered up this market rally.
So the market structure itself was forcing prices higher.
Exactly. Everyone was selling their hedges and pouring money into mega-cap tech. And what is really fascinating from Monday's data is this glaring omission put interest in single stocks never really surged after the Iran situation started.
Wait, really? So nobody bought insurance?
Nobody bought insurance. The market was completely unhedged for disaster. Traders simply do not buy the downside protection you would mathematically expect. They were too busy adding another floor to that penthouse.
Wow. Which means we have this fragile, totally unhedged market heading straight into Tuesday, April 21st. And this is where the tension hits a critical deadline.
Right. The ceasefire deadline in the Middle East is looming for Wednesday evening.
And the rhetoric is rapidly escalating. Former President Trump publicly states that a ceasefire extension is highly unlikely, and he warns that without a deal, lots of bombs start going off.
Yeah, and at the same time, Vice President Vance is actively flying to Pakistan for emergency talks.
And to the market, These political developments aren't about right or wrong. They are simply real-time, high-stress data inputs. We have literal warnings of conflict, and we have to look objectively at how the algorithms digested those headlines.
Because the facts on the ground were undeniable. You have warnings of bombs going off and diplomatic deadlines expiring in 24 hours. Any human reading the newspaper would expect a crash.
And yet, the market barely blinks.
It's wild.
The S&P 500 closes down only 0.6% at 7,064. And when we look at the 0DTE options data, the pricing for the 0DTE straddle, which is basically a bet on immediate volatility, is sitting at, well, the notes call it bottom basement levels.
Yeah, the market is pricing in absolute, total calm.
And I have to actively push back here. Why is the market's fear gauge effectively snoozing while literal bombs might go off? I mean, how can human traders just ignore this?
This raises an important question, and, well, the uncomfortable answer is that the modern intraday market doesn't really trade on human emotion anymore.
It doesn't.
No, it trades on the mechanical positioning of massive funds. The SpotGamma notes highlight a structural force called pro-customer gamma.
Okay, what is pro-customer gamma?
Well, we all know market makers maintain positive gamma to balance their books, but regular retail customers do too. So who takes the other side of that trade? The answer is pro-customers. These are high-frequency trading funds, or HFTs. They operate much like market makers, and going into Tuesday, they were taking massive, record-breaking negative gamma positions.
So just to make sure we all tracking these algorithms, and HFTs aren't sitting there watching the news and getting anxious.
Not at all.
They're just structurally providing liquidity and selling volatility based on the math.
That is the core of the Tuesday disconnect. The options market's structural term structure was sitting at its absolute lows because the algorithms running the funds simply weren't positioned for downside protection.
They just assumed the violence wouldn't restart.
Right. It's crucial for you listening to understand this. The machines that drive daily market liquidity are trading the mathematical probability of volatility based on options pricing. And on that Tuesday, despite the headlines, the math simply said, sell the volatility.
Okay, so the human traders are unhedged, the machines are mathematically forcing things to stay calm, and everyone is betting on tech. But, you know, gravity has to kick in eventually.
It always does.
You can't build a penthouse on a fault line forever without feeling a tremor. Which logically brings us to Thursday, April 23rd.
Right, the day the bill comes due.
Exactly. The geopolitical tension finally reaches a boiling point. Brent crude oil spikes over $100 a barrel. And this is where that structural plumbing we just talked about gets severely tested.
Yeah, the S&P 500 begins to drop under the weight of that $100 oil, and it tests a critical level that SpotGamma identified earlier in the week, the risk pivot level at 7,050.
And when the market hits that specific number, it triggers a classic seek and destroy intraday dynamic.
Yeah, let's break that down. As the market drops towards 7,050, the options environment violently shifts from what is called positive gamma to negative gamma.
Here's where it gets really interesting. Think of positive gamma like driving a car with massive state-of-the-art shock absorbers.
Okay.
Every bump or pothole, which represents a market move, gets smoothed out. Dealers buy the dip and sell the rip to balance their books, which keeps the market incredibly stable.
Right, it forces a tight trading range.
But negative gamma, that is like driving on pure black ice.
The black ice visualization perfectly explains the mechanics. Because when the market crosses that 7,050 threshold into negative gamma, the shock absorbers just disappear.
The dealers are forced to sell.
Mathematically forced, when the market drops, they have to sell to hedge their own books. They aren't smoothing the ride anymore, they are hitting the accelerator on the crash. Selling creates more selling.
And we see this vividly in the S&P 500 IRO data, right? IRO being the indicator that tracks real-time directional pressure from options flow.
Correct. The IRO flow reversed violently intraday, reaching negative $2 billion in negative delta. The market was just cascading downward.
And as a quick aside, some single stock bets really paid off during this slide, didn't they?
Oh, massively. Earlier in the week, SpotGamma flagged a $12 million premium outlay on the IGV software ETF for $75 puts.
Wow.
Yeah. As the market slid and software stocks weakened, those specific puts exploded by 50% in a single session. That is a massive institutional win hiding right there in the data.
But the broader index is in free fall. We are on black ice, dealers are selling, and it looks like the trapdoor is going to fully open. But then, and this is crazy, the SpotGamma notes point out a sudden, massive shift in the mechanics.
Yeah, right around 1:45 p.m.
The data shows 5,000 lots of 0 DTE put spreads were opened near the 7,035 strike. Someone just stepped right into the path of a falling market with a massive block of trades. Can you explain how buying those puts actually stopped the crash?
This is the invisible plumbing at work. Those 5,000 lots of 0 DTE put spreads acted as a giant emergency brake.
But how? They bought puts, which is a bet the market goes down.
Right, but here's how the mechanism works. When a major player buys that massive chunk of put spreads, the market makers on the other side of the trade are suddenly holding all that risk.
Okay.
To hedge that specific new risk, those dealers are mathematically required to go into the actual stock market and buy futures or shares.
Oh, so by buying a bet that the market would go down, they actually forced the dealers to buy the underlying market, creating an artificial floor.
It is entirely counterintuitive, but yes. The hedging required by those 5,000 lots provided immediate near-term support. It completely stopped the bleeding.
And caused a sharp V-shaped recovery in the index between 1.40 p.m. and 2.0 p.m.
Exactly. This is why understanding this plumbing is so vital. If you are just watching the news, you might panic sell at 1:30 p.m. because oil is over $100, the Middle East is a mess, and the market is tanking.
But if you see the gamma levels and the options flow, you realize you are panic selling at the exact moment the machines are stepping in to put a structural floor into the market.
You are literally selling your shares to the emergency brake.
That is just wild. Okay, so because the machine successfully installed that invisible floor on Thursday, the market didn't collapse. We
Right.
survived the black ice.
Yep.
And that sets up a massive collision for Friday, April 24th. Suddenly, the macro news flips. Israel and Lebanon extend their truce by 3 weeks.
Right, so the immediate geopolitical pressure is off, and oil falls back below $100.
Now, what happens when you completely remove the geopolitical weight from a market that, as we established on Monday, was already unhedged and fundamentally desperate to buy tech calls?
The result is an absolute explosion to the upside. I mean, the market rips to a new all-time high. The S&P 500 closes at 7,165, up 0.8% on the day.
And the NASDAQ 100 jumps a massive 1.9%. The semiconductors just went completely ballistic.
Oh, yeah. The SMH Semiconductor ETF gains 5%.
Intel rips higher by an astonishing 25% following their earnings. AMD is up 14%. ARM is up 15%. It's a total face ripper of a rally.
It really was.
But reading the daily notes, this wasn't just fundamental buying because the news was good, right? It was another mechanical option squeeze.
It was heavily driven by the plumbing again. Around 11:30 a.m. on Friday, massive gamma formed at the 7,150 strike on the S&P 500. This created a scenario known as positive delta flow.
Okay, break that down for us.
So, when retail and institutional traders rush in to buy call options because the news is suddenly good, the dealers selling those calls are exposed. To cancel out that risk, those market makers are forced to go buy the actual S&P 500 index.
And as that dealer buying pushed the market toward the 7,150 level, a trap was sprung.
Yes, they were completely trapped. Everyone who was short those 0 DTE calls was suddenly underwater with only hours left before the contracts expired.
So they panicked and were forced to buy the underlying index to cover their positions at any price.
Exactly. This panic buying added pure rocket fuel to the momentum. The data here is staggering. The 0 DTE 7,150 calls rallied from about $3 to roughly $19 in just 90 minutes.
Wait, 90 minutes? That is a 600% gain in an hour and a half.
It's insane.
600%. You go to a long lunch, you come back, and your options contract has gone up 6 times in value.
And the big players weren't just playing this intraday game either. Once the pressure was off, they started placing massive forward-looking bets on Friday afternoon.
All right, looking at the notes, Amazon saw $30 million spent on June 220 calls. Qualcomm saw $13 million on calls. And Caterpillar had $20 million spent on upside calls.
Huge, huge bets.
So what does this all mean? How is a regular retail investor listening to this supposed to make sense of a market that can swing so violently on 0 DTE option flows, seemingly totally independent of the actual underlying company's fundamental value?
What's fascinating here is that the tail is now truly wagging the dog. Historically, traditional investing meant you bought a stock because you liked the company's cash flow or their management.
Right, and the options market was just a secondary derivative used occasionally for hedging.
Exactly. But today, the massive volume of options trading, specifically these extremely short-term, 0 days to expiration contracts, actually dictates what the underlying stocks do.
Because of the hedging requirements.
Yes, when billions of dollars in 0 DTE options are traded in a few hours, the market makers who facilitate those trades have to buy and sell the actual stocks to stay neutral. So for you, the listener, the takeaway is clear. Watching the financial news on TV just isn't enough anymore. You have to watch where the major options strikes are sitting, like that 7,150 level on Friday.
Because those levels change the physical structure of the market.
Right. In a negative gamma environment, those levels act as trapdoors. But in a positive gamma squeeze, they act as trampolines for the entire market.
It has been an incredible journey through just 1 week of market data. I mean, we started on Monday with a market completely ignoring severe macro risks because of overwhelming, almost stubborn call buying in tech.
Yeah.
Then we saw the fear gauge effectively snooze through literal bomb threats on Tuesday because high-frequency algorithms were mathematically forced to sell volatility.
We watched the invisible safety nets of 0 DTE put spreads act as an emergency brake to halt a Thursday crash right at the critical 7,050 level.
And finally, we witnessed a spectacular 600% options squeeze push the market to staggering all-time highs on Friday once the geopolitical weight was lifted.
The events of this week perfectly illustrate how complex the modern market structure is. It is a machine made of math, probability, and dealer positioning, rather than just a simple reflection of human sentiment.
And that is exactly why we do these deep dives.
Yeah.
The shortcut to being well-informed isn't just reading the front page of the financial news, it's understanding the mechanics beneath the surface.
Because knowing where the gamma flips occur gives you an edge.
Exactly.
Yeah.
Knowing where the trapdoors and the emergency brakes are hidden gives you a distinct advantage over those who are simply reacting emotionally to headlines.
If you understand the mechanisms, if you know where the structural guardrails are, you are much less likely to panic when the car hits a patch of black ice.
Beautifully said. Now, before we go, I want to leave you with a final provocative thought to mull over. We just saw how zero-day options flows can violently dictate the intraday direction of the entire S&P 500, literally overpowering the news of a global conflict, halting crashes, and forcing massive short squeezes. So the question is, are we still actually investing in the underlying companies anymore, or has the stock market simply become a derivative of its own derivatives?
That's a great question.
Thank you so much for joining us on this deep dive. Keep questioning those surface-level narratives, keep looking for the invisible plumbing, and we will see you next time.